Cramer. Welcome to Mad Money. Welcome to Cramerica. If you want to make friends, I'm just trying to save a little money. My job is not just to entertain, but to put a day like today into context. So call me, 1-800-743-CBC. Tweet me at Jim Cramer. Happy third anniversary of the great bull market of the 2020s. Nothing like a major flare-up in the trade war with China to put an end to the celebration before it even started, though. Dow plunging 879 points, S&P plummeting 2.71%, NASDAQ nosediving 3.56%. It was a real ugly day, and the sell-off probably not done yet. Even with today's beatdown, it's been a huge run over the past 3 years, tremendous move that's embraced many sectors and led to gigantic gains. You're much more likely to keep those gains, at least if you just take a little something off the table, even up here, because we're way up. Do I think today marks the end of the multi-year rally? No. But I do think we've grown complacent and overly optimistic about President Trump's trade policy ever since the post-Liberation Day bottom in April. Trump's Truth Social posting today shows that the China relationship is not good, with Trump canceling his meeting in 2 weeks with President Xi, and just an hour ago calling him hostile and saying he's now going to impose 100% additional tariffs on Chinese goods. That's almost all the way back to the initial level from Liberation Day, and it is sure to hurt many Chinese businesses. For good measure, by the way, he's adding on export controls on critical software to try to rival Chinese husbanding of critical materials that only they have in scale. It looks like a relationship that the president often called a good one wasn't all that good after all, and it just got a heck of a lot worse. Until today's vicious decline, we were far more focused on how much the Fed will cut rates to help jumpstart the economy. I went down to the Fed yesterday and led a panel of smaller banks. They all said that rates are too high and are stifling business, suffocating growth. It was a very constructive, enjoyable meeting. But one Truth Social post obliterated those good vibrations. I do thank Vice Chair Bowman for the opportunity, though. Now, we bought a little bit of stock, not a lot, for the Chapel Trust today, and we only did so because there could be some of that art of the deal thing going on. Maybe something's resolved over the weekend. Trump was reacting to still one more trouble point, another squeeze on rare earth minerals by President Xi to show the West who's in charge. The timing of that action, so close to the president's peace deal in Gaza, didn't sit well with Trump. Still, I don't expect relations with China will sour to the point where all of today's declines can be justified. We need them, and they need us. And they are, you know what, they're hit a lot harder than we are by these new tariffs. At the same time, I am conscious that we're heading into the seasonally strongest time of the year. I don't want to pass on these instant opportunities for companies that can benefit from rate cuts or from having their stocks rendered cheap because they are in the S&P 500, the big basket that takes down everything, the good, the bad, the ones that are hurt, and the ones that aren't. Which brings me to our game plan for next week. Monday, we'll be coming to you from the San Francisco Bureau as part of my annual pilgrimage to Dreamforce, Salesforce's tech extravaganza. We'll be sitting down with some of the most important people in tech, among others. It's going to be amazing. I expect to get some clarity on the 100% tariffs that the president will slap on China. The ripple from his comments turned into a torrent as the session went on, and I'm guessing he doesn't want to see the stock market coming unglued here. The president likes things big and beautiful, not anemic and ugly. Tuesday, it starts earnings season, like I tell you in How to Make Money in Any Market, available on Amazon. This is the period that defines most stocks, the earnings season. Tuesday's a big day for earnings. Just in the morning, we have 3 stocks we own for the Chapel Trust: BlackRock, Wells Fargo, and Goldman Sachs. All 3 have had a good run for the year, and they aren't exactly in the crosshairs of the trade wars. I think Goldman Sachs is liable to have the biggest upside surprise. I hope Wells Fargo CEO Charlie Scharf says he's willing to buy back more stock if it comes down at these prices. Not to be outdone, JP Morgan reports too, and it should be a usual superb quarter. You may wonder why we don't own that one for the Chapel Trust too. Simple. One of the things you're going to learn if you join the club, you can't own them all. You already have 4 financials in a 32 stock portfolio. We get results from Citigroup as well, and I got to tell you, close observers think that bank run by the affable, cerebral Jane Fraser will put up the best numbers of all. Beyond the banks, we hear from Johnson & Johnson, which should have the strongest numbers of any pharmaceutical company. The stock shrugged off a bad loss in one of those talc lawsuits where the plaintiff accused J&J of knowingly selling a product that contained a carcinogen asbestos. I think that the stock didn't go down, but actually went up. That it's a sign that the stocks finally stopped being hostage to these interminable lawsuits. Domino's reports, too. Now, this is interesting. A lot of people think they're going to miss the quarter. We got to hear from more banks on Wednesday, and I've got to tell you, Bank of America tends not to do all that much, but Morgan Stanley has been surprisingly positive for this last several quarters. Ted Pick shooting the lights out over there. We also get results from one of the most reliable healthcare companies, Abbott Labs. We've owned Abbott for the trust for almost ever, and I think it's just terrific. What else? Well, Salesforce holds its analyst meeting on Wednesday at Dreamforce. And this charitable trust holding has been under pressure. It is down an astounding 27% for the year. I think it's because AI eats software, as they say. A twist on software eating all of tech not that long ago. I'll tell you how it is for what's becoming a brutal stock to own when I go out to Dreamforce. There's also, get this, a Dollar Tree meeting, okay? Now, this stock has been under pressure, too, largely because of tariffs. It was barely down today, which seems too positive, given that our president's threatening to put these 100% tariffs from China. I think they will get hurt, and numbers have to come down, and they'll do it at the meeting. Wednesday evening, we get arguably the best possible read on this almost dataless economy when trucking giant J.B. Hunt and United Airlines report. J.B. Hunt tells it like it is. They've been talking about a freight recession for ages. United can tell us the difference between the front of the plane, corporate customers who pay a lot of money, and the back, where regular people do their flying. Thursday morning, Taiwan Semi reports. I usually get up at 2:30 in the morning because that's when they report, for heaven's sake. This manufacturer of chips for both AMD and NVIDIA and many others will give us an overview, and I expect a very rosy picture. Schwab gives us his numbers, too. And why do I want to look at this? Well, I like to look at retail participation in the market. I think more and more people are coming back to stocks, one of the reasons why I wrote my book. And I hope today's meltdown doesn't drive those people right back out. They won't if they read it. After the close, we're going to attempt to learn why CSX fired Joe Hinrich not that long after he was named Railroader of the Year by Railway Age. I don't know the details, but I'll tell you something. It looks like Joe was railroaded. Finally, Friday, what we hear from American Express is this is one of the most reliably unreliable patterns. Amex has a tendency to decline right after it reports. Then you have to pounce because a week later it turns out to be going much higher, and you've lost your chance. I don't think it will be any different this time. We also get results from SOB, the old Schlumberger, and I bet this oil service titan tells it like it is. To me, that means oil, which broke through $60 a level, could break down below 60. I think it could go to 55, and that's a distinct possibility. The bottom line, it's a wild week, complicated by precipitous decline in Treasury yields, which normally would signal better times ahead. But after today, it's hard to think of anything positive that can happen and a lot of negatives that might definitely happen. Let's speak to Mark in Virginia. Mark.
Booyah, Jim. Long time viewer here.
Thank you. What's up?
I've been holding Ford stock for quite a while. It's been a tough week for Ford. I stayed invested even when it climbed rather than taking profits because I believe in the company and appreciate the dividend. Do you think it's still a solid long-term hold, or is it time to reconsider my position?
Okay, I was thrown by the impact that this fire had, and it's caused me to recalibrate. I do think that Ford's good, but I think numbers might be too high because that fire hurt so many parts of their operation. All right, I know today makes it hard to think about anything positive happening next week, but I believe after another little dip, perhaps some money, that we could get some good news. We've got earnings coming up. On Mad Money tonight, if you break up with your girlfriend or wife, it's not great. But if you break a company up, well, it could be one of the greatest things to ever happen to you as an investor. I'm taking a closer look at Honeywell and DuPont and giving you my take on the splits. Then, if you're trying to get a read on Europe, there's no better place than Banco Santander. I'm sitting down with the company's CEO to get a grasp of what's going on. And next week, as I just mentioned, we head out west for Salesforce's Dreamforce conference, and I'm giving you a preview of what we have on deck. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Regular viewers know that I love corporate breakups. Breakups between people, tragic, tough to see. You'll have to trust me on that one. But when a company breaks up, it can often unlock value and generate big gains for shareholders. That's been on my mind a lot lately because not one but two of our holdings in the Travel Trust are currently going through breakups. DuPont, the specialty chemicals company, is spinning off its electronics business, and Honeywell is doing a three-way breakup, starting by spinning off its advanced materials division. That's going to happen later this month. More on that in a moment. For now, I want to talk about DuPont. Even though DuPont has a long history, founded as a gunpowder mill in Delaware in 1802, the current DuPont is itself the product of a complex merger breakup. Back in 2017, the original DuPont merged with the old Dow Chemical. Then they split up into three separate companies: Dow for commodity chemicals, Corteva for agriculture, and the remaining specialty chemicals business sticking around as the new DuPont, which is what my trust owns. Unfortunately, the new DuPont, it's been kind of a disappointment. Didn't help that the breakup finished not long before COVID hit, but even after the stock rebounded from its pandemic lows, it's basically been trading sideways since early 2021. We bought this one for the Travel Trust in the summer of 2020 when it was still very cheap, and only sold most of the position in early 2021 for a real big profit. But you know what? We kept some on, always wanted to see what would happen, and it's been a real slog. You could argue a mistake. We are long-termers, though, if we see value, and I wanted to stick around because of a fellow by name of Ed Breen, DuPont's current executive chairman, who's a breakup specialist dating back to his days running Tyco International 20 years ago. Breen helped orchestrate the original Dow-DuPont merger breakup, too. Even though he's not the CEO anymore, I figured it was worth owning this one because, well, given his track record, Breen would be able to find some way to extract value. And about 18 months ago, we learned how that was going to happen. In May of last year, DuPont announced plans for a three-way breakup by spinning off its electronics and water units, both of which are leaders in their respective fields, leaving behind a pure play on specialty chemicals. But then this January, the company changed its mind, saying that it would actually retain the water business, only spinning off its electronics unit. They wanted to keep water and focus on unloading the electronics biz as fast as possible. Once they get it done, it'll be called Qnity, Qnity Electronics, with the ticker symbol Q. Last month, the process started to pick up steam. In mid-September, DuPont held Investor Day events for both Qnity, that's Qnity Electronics, and the remaining DuPont business. On September 24th, they set a record date for the Qnity spinoff. It's going to be October 22nd, not far from now. DuPont shareholders at that date will be distributing Q shares, though the exact ratio hasn't been decided yet. And Qnity will start trading independently at the beginning of November. So what are you getting with each of these companies? Let's start with Qnity Electronics. Unlike some spin-offs where a slower-growing, less exciting part of the business is being jettisoned, this is actually the more exciting part of DuPont's business. Most of Qnity is tied to the semiconductor industry. About 65% of the sales are chip-related. Their customer list includes the world's leading semiconductor fabs like Samsung, Taiwan Semi, as well as chip makers like NVIDIA, Micron, and Intel. Familiar names for you. Beyond chips, they do things like advanced interconnect and thermal management products. Qnity's technology includes materials used for the actual polishing and etching of semiconductors' complex product, as well as advanced packaging and thermal solutions. And management insists that this stuff is all integral for the development of leading-edge chips. It's a great value proposition. I've checked it out. I really like it. And hey, the numbers for Qnity look pretty darn good. Okay, so net sales are going to expect to grow 7% year over year in 2025, and that's driven by the AI boom, which is driving demand for the most advanced types of chips that Qnity helps with. The company also expects to see its earnings for interest, tax, depreciation, and amortization margin grow by 100 basis points to 30%. That's a great number for an industrial-type company. Put it all together, and I am a fan of this one. As for DuPont itself, I think the company's doing its best in a very tough economic environment, but you need a bit of faith to believe in their outlook for the future. Looking back a few years, even though DuPont's sales growth has been basically in line with other specialty chemical makers, its stock has had a much lower, really reduced valuation. I would call it, yeah. Some of that's because the margins are a bit below average, but generally it's just been very cheap. So to start, there's a value argument to be made for DuPont right here, right now, even if it's the wrong point in the business cycle to own most chemical companies. And it is most definitely wrong. Looking forward, though, DuPont's exposed to some very strong end markets like healthcare, the water that they kept, diversified industrials, and they have some strong leadership positions in each space. Now, at this Investor Day, DuPont put out some medium-term financial targets. They're talking 3 to 4% organic sales growth, 150 to 200 basis points of EBITDA margin growth, and a compound earnings growth of 8 to 10%, all while sustaining a high level of free cash flow generation. And you know what? Those numbers sound great. In fact, you could say they sound incredible. I use that word if you look at DuPont's recent results. These medium-term financial targets might be a little hard to believe, frankly. This latest quarter, DuPont had just 2% organic growth, much of that coming from the very strong Qnity business, which they're about to spin off. So can they hit those targets? Look, we own DuPont for the Charitable Trust, as I mentioned, so you know I'm a believer in the story. However, they won't be able to hit those numbers without a series of rate cuts. So this is how important these rate cuts for the Fed are. They're really helping the quarters of something like Honeywell. I think we'd get the rate cuts in the stocks and DuPont. I think the cuts in the stocks certainly they're cheap, but you need to know what you're betting on. In the end, I'm very bullish on the Qnity spin-off. It should keep doing pretty well. Semiconductors stay hot thanks to the AI boom, despite the tariff news that we got this very evening. But as for DuPont itself, the bottom line is that right now, what this company has got going for it is a cheap valuation. Without some rate cuts, it's going to be tough to own. That said, I still believe that Executive Chairman Ed Breen can unlock a lot of value here, just like he did with Tyco and Dow DuPont in the past. Stick around, and I'm going to give you the juicy details of the other breakup that I like, the one I just mentioned, the Honeywell break. Mad Money is back after the break. Oh, man, what a brutal session. But we carry on because we know that even when it's tough, we can indeed make money in any market. How could I not miss this opportunity? So let's get to work. Tonight, we're talking about one of my favorite subjects. We're talking about breakups. In real life, not a fun topic, but in the stock market, breaking up a business can unleash a tremendous amount of value if you're patient. I'm always talking about the Wall Street fashion show. You know that because stock prices are usually set by a relatively small number of money managers who are tastemakers, let's call them that. And for the most part, these institutional money managers, they like simplicity. They like stories that are straightforward and easy to get your head around. That's why these corporate breakups can be so profitable as you work through them. A lot of big companies are simply worth more than once they're split into 2 or 3 different pieces. Earlier, I walked you through one of my absolute favorite, DuPont, and its planned spin-off of its electronics division. Now I want to highlight the most unheralded Honeywell breakup, the spin-off of its advanced materials division as Solstice, followed by the spin-off of its automation business. And I really like this one. My Charitable Trust has owned Honeywell for more than 5 years. And initially, it was a big winner, rallying from $150 where we bought it to well over $200. And we took some off the top of that by early 2021. It had already gotten there. But then the stock became a battleground, and owning it has been pure struggle. It's been consistently underperforming for us. But we have held on to it precisely because the company is now committed to bringing out the value through a breakup plan that we wholeheartedly endorse. During this period, Honeywell's been held back by lingering supply chain issues, then underperforming side divisions. There always seemed to be some snag that prevented them from blowing away the numbers. Now, a lot of investors threw in the towel, giving up on this big industrial conglomerate. You might argue that could be right. I think there's much more ahead. See, I stuck with it, though, in part because Honeywell kept growing and because some of their core businesses, like aerospace, seem incredibly undervalued. For the past couple of years, I've been trying to give them the benefit of the doubt to Vimal Kapoor, who took over as CEO in June of 2023, came on the show back then, but only really got control when he became chairman of the board a year later. And I think he's doing a fantastic job. A few months after that, he announced his plan to break up Honeywell by spinning off its advanced materials business. That was a core business. About a month later, the activist hedge fund Elliott Investment Management got involved, and they took a $5 billion position in Honeywell. That was the largest investment ever in a single stock. Elliott's got a great track record, and they urged Kapoor to go even further with his breakup plans. You know what? To his credit, what did he do? He listened. In February, Honeywell announced that instead of just spinning off the advanced materials business, which is a small part of the company, it would break up into 3 pieces: aerospace, automation, and advanced materials. Now, the stock got hammered by tariff worries, but after the big Liberation Day washout, this thing rebounded all the way back to the 240s in July. This was some move. Just some move. I mean, it seemed like every hedge fund and his brother was in there, though. Unfortunately, when they reported their most recent quarter, the aerospace numbers came in a tad light. And since then, the stock has just been hammered, sinking back to $200 and change as of today. We almost pulled the trigger on buying some, but we knew it was such an ugly day. We said, let's see what happens Monday. But a week and a half ago, we learned that the breakup has arrived. Honeywell announced it is ready to complete the spinoff of the Advanced Materials unit as Solstice Advanced Materials with the ticker symbol SOLS. We'll get 1 share of Solstice for every 4 shares of Honeywell. And Solstice will start trading independently on October 30th. Quite exciting. Well, I mean, if you're into stocks like I am. Then 2 days ago, management held an Investor Day event for Solstice, and it gave Wall Street a closer look at what the new businesses will look like. Okay, so get this. Solstice will be a mid-sized specialty chemical business with nearly $4 billion in sales. 1/3 of the business comes from the regular refrigerants. They sell it to heating, ventilation, and air conditioning companies, HVAC, along with appliance makers like Whirlpool. They've got a large portfolio of building solutions and intermediary products for construction. They provide alternative energy services and sell in the nuclear industry. They even make chemicals for other chemical companies, including DuPont, which I just talked about before the break. At this week's investor meeting, Solstice emphasized that the company's selling into some attractive end markets with strong secular trends, including the growth of advanced computing, the evolving energy landscape, as well as healthcare, personal safety, and defense, all secular growers, as far as I'm concerned. In terms of Solstice's numbers, this used to be a pretty strong business, but more recently it's been less than stellar. You can understand why. Honeywell's happy to spin it off. Sales growth has slowed dramatically over the past few years, and it's set to be pretty much flat for 2025. That is not good. Their EBITDA margin expected to dip too, although that's mostly thanks to higher costs stemming from the breakup. I don't hold it against them. Overall, Solstice is a solid business in an industry that's currently challenged. I've talked a lot about the two economies, the booming economy for anything connected to the AI data center, and the not-so-hot economy that includes virtually everything else. Solstice has a little bit of exposure to data center, but that's not really fair to call it that. It's not big enough to offset the weakness in the company's more cyclical markets. So I wouldn't be surprised to see the stock dip after it starts trading independently. But that's what usually happens when you spin off a stock to existing shareholders. Many Honeywell investors simply won't want Solstice. A lot of the S&P funds have to kick it out. However, once the economy stabilizes, ideally after we get some more rate cuts, you know what? This is going to be a winner, maybe a huge winner. It's just that we were wrong in the wrong part of the business cycle to own something like this. At the moment, I'm glad they're getting rid of it. I need the stock of HON to go up for my trust. As for Honeywell, I am optimistic that with this breakup finally happening, they can start unlocking real value. Keep in mind, there's a second step to the breakup. They're planning to spin off their automation business by the second half of the year. It's next year I'm talking about. At that point, the remaining Honeywell will be almost a pure play on aerospace. And aerospace is a phenomenal business. Phenomenal. Look at how GE Aerospace has done since it spun off its healthcare and power divisions. The stock's been a giant winner. It wasn't when they had those other divisions. Sometimes the spinoffs do even better. Look at GE Vernova, their power business we own for the Charitable Trust. That stock's run from the low 100s to the low 600s since it became public independent in April of last year. So let me give you the bottom line on a complex story that I think is going to make you money, but you got to be patient. The age of conglomerates ended a long time ago. These days, we've seen so many breakups create immense value for investors, and now Honeywell's about to join the club as it spins off its advanced materials business as Solstice later this month. I can't be too enthusiastic about Solstice until we get more rate cuts from the Fed, but it might be worth buying on weakness somewhere down the road. As for Honeywell, the Charitable Trust is in this one for the long haul because Vimal Kapoor's three-way breakup plan will finally unshackle the company's phenomenal aerospace business. I think that'll be worth a heck of a lot more once the other divisions get spun out. As this stock goes down, all I can say is opportunity beckons. Let's take questions. Why don't we go to Jason in Florida? Jason.
Mr. Cramer,
Jason.
As a blue-collar guy who was not brought up learning strong financial fundamentals, I want to truly thank you for the work you do to help educate all of us. I've read the book, and I'm diving.
Oh, you did?
Of course, I loved it. I thought you wrote it for me. So I'm diving into the homework. I wanted to ask you, with the worldwide demand to replace aging fleets and its backlog of orders, what do you think about Boeing as a candidate?
I think Boeing is a must-buy. I have looked the CEO in the eye. I think he's a terrific guy, Ortberg, and I will tell you this. This company just gave up a huge percentage of the gain it has had. And why buy anything at the top when you get something near the bottom? That's Boeing. And thank you for the kind comments about my teaching. I can't be too bullish on Solstice yet. but I can be all in on Honeywell. I think this breakup will make it worth a heck of a lot more. Remember, it was in the 240s not that long ago. Now, much more Mad Money. Even on a tough day like today, it's worth keeping an eye on the banks as they have some of the hottest in this market. We've got the hottest, almost my exclusive Spanish bank, Banco Santander. Then, whether it be nuclear, Bitcoin derivatives, or quantum, there will be a piper paid for the exuberance in this tape. I'm sharing you why I think the froth is going to cause problems. And, of course, all your calls, rapid fire, lightning round. Stay with Cramer. Even on a bad day like this, it's worth keeping an eye on the banks as they become some of the hottest stocks in this market. And that includes the big international players like Banco Santander, which I like very much. It's doubled since we saw the CEO last. They have been on the cutting edge, focused on AI and the future of banking. Earlier today, I sat down with Ana Botín. She's the executive chair of Banco Santander. So take a look. Before we get into the nitty-gritty, I do want to say people stop me all the time about NVIDIA. They should be stopping me about Banco Santander because your bank's stock is more than double this year versus NVIDIA.
Hi, Jim. It's great to be back. I think I was here a year ago. Yeah. And yes, we have basically doubled. I say this is an overnight success, 10 years in the making.
Well, I don't want to be tawdry by talking about it, but I think in the end, it's important to know that you are probably the best creator of value in your group. Now, you're also I think, the most difficult because you've committed yourself to 10 countries, some of which are always in flux. You are the world's banker, and I want to know what you're seeing, strongest loan demand, weakest, and how your AI strategy is working, because that was something I basically think you introduced on our show at one point.
So, Jim, those are many questions. Let me take the first one.
Well, you were able to handle many things at once. How about that?
Well, that's my job, absolutely. So, we are today we have become a global financial powerhouse with 175 million customers, but the focus, 80%, are Europe and America. So most of our markets are in Europe and Americas. If you think about what are the strongest ones, by global businesses, we're growing more in corporate banking, wealth management, payments. By geographies, I would say Mexico, US, and Spain. I think those are the strongest geographies in the last 12 months, and it looks like going forward.
Now, you're also in areas that are affected by nationalism, by political turmoil. Somehow you've been handling these as if they are just the same as a slower or faster economy. These are difficult things to manage, but you do them. One, I want to know how you do it, and two, where is it most problematic?
So one of the great strengths of Santander is its diversification, again, by global business and by geographies. This allows us to allocate capital dynamically across businesses and geographies on a weekly basis. So we can go where the best risk return is. And this is a huge strength at times like these because, again, if you go back 2 decades, our results are the most predictable, the least volatile among our peers. And this is a huge strength. And again, going to the best risk return on a very dynamic basis means I can maximize returns for my shareholders through the cycle.
Now, Mexico is strong. I'm going to talk about that. But Brazil, you've got a huge presence in Brazil. And I've always felt that Brazil was so-called dicey, as I did Mexico. Maybe I and many Americans have the wrong vision and view of these two countries, which are making you a lot of money.
If you ask me, looking forward, so our share price is up 100%, but I think the best is yet to come. And this is the reason why I have huge confidence we will again deliver. And it's all based on what I call going from a federation of banks to a global financial powerhouse. So our global businesses and the structural change in the business model will help us be more profitable in every single market. And this is really important. How are we going to do it? By leveraging our scale to build global platforms. And Open Bank, which we launched here last year, is just one more example of that.
Well, let's talk about that because you are at the forefront of something that I felt that no one else recognizes. Getting Gen Z people to invest. And a lot of that is because, one, your digital offering is superior to every one of the traditional banks. And second, you offer the best rate. And they understood it. And it looks like they're saving and not spending as much because of what you offer.
So this is, in today's world, either you're very big or you're very specialized. And we have the scale to be one of the big global platforms to deliver for Gen Z, but to you also, to everybody, the best products, best customer experience at competitive prices. And this is really important. Why? Because we are building our own platforms. Okay, Open Bank is our own IP, our own software. Gravity is our backend, and this is what will allow us to deploy the same platform, same user experience across all our platforms. And hopefully, in the next 12 months, we'll be able, for example, to connect Open Bank US with Open Bank Mexico, Santander also, but this will allow you.
You're telling me that it could be fluid?
Yes, instant. I mean, literally seconds. With an account with Santander in the US, Open Bank US, Open Bank Mexico, you're able to transfer instantly.
That had always been a major stumbling block. You were talking about something that has kept our two countries separate for a long time. I know that there are issues in Washington separate, but financially we'd be very much together.
So we're going to be on both sides. In the US and Mexico, we can onboard customers to the level and the trust of a bank, and we can allow you to actually work cross-border as an individual, as a company, during 2026.
Now, I also think people should understand that you've embraced AI to the point where you have brought in OpenAI in a very, very aggressive way, and I think it's probably kept that efficiency ratio to be as spectacular as it is.
So I say AI is everywhere at Santander. We're on a journey where every decision, every process, every customer interaction should be data and intelligent, analysis driven. This means that by the end of this year, we're going to have 30,000 OpenAI users inside Santander, but there's a lot more to be done. So there is a huge potential because once you have your own global platforms, getting AI inside is much easier. So this is really the journey we're on, massive opportunity ahead. And just two numbers to prove that this is happening. In the last 12 months, we grew 8 million customers. Right. That's a population of New York City in 12 months, and our costs are flat to down across the group.
Right. Now,
and our efficiency, 41.5. That's best in class among the best banks.
Okay, so no bank is doing, other than perhaps yours, I really want to understand this. We're supposed to be using these as basically digital assistants so that we can get twice the productivity out of a banker. I'm afraid that what people do is fire half the bankers, which is get the same result, but it's very short-sighted. Are you using AI digital assistants to get more productivity out of bankers right now?
That's how we see it. We see AI as helping us do better for our customers and better for our shareholders. And this is the key. If you look at our track record, 10 years since I took over, we have more than tripled profits. We have multiplied by 6 shareholder remuneration. Over the last 2 years, our EPS is up 19%. And a lot of this is investment. So we give great returns to shareholders, but we're investing. And we see it as making us do things of more value added to you as a customer. And I can give you examples of how this is happening.
No, sure, because you're the only one doing it. I need to know how you're able to do it.
Well, at the end, it's a cultural issue. So, I have personally programmed. We have an alliance with Cognition. It's a San Francisco company. They have an agent called Devon. So as part of our latest management meeting, everybody, including myself, used this agent to program. And you realize how it really helps you. If you understand the business and you have the right partners, you can build amazing tools, not just for productivity, but for growth.
Well, I think people should understand that you basically have a shadow board of directors, too, where you have very high-level people. For instance, George Kurtz from CrowdStrike, that you brought him in. I think I've been waiting for people to say, you know what, he's a genius about cybersecurity. Well, he's on this board that I'm talking about.
So when I took over 10 years ago, we had an advisory board, which was basically everybody that left Santander was put into the advisory board. So the first thing I did is send them all home, respectfully. And then I tried to look for the best people that understood technology and what was coming. So George Kurtz has been with us for 10 years. Jim Whitehurst, the founder of Red Hat.
Fantastic guy.
Fantastic guys. Mike Rodin from IBM, he understands the deep tech. Sheila Bair. So the list is long. It's actually many Americans. Marty Chavez, ex-CFO of Goldman Sachs.
Sure.
Who's a software developer. So these guys have been incredibly helpful and they've always been available to challenge us on our tech, on our product. So incredibly grateful, amazing advisory board.
Now, to go full circle, I want people to understand, and you can speak for it, obviously, your commitment to shareholders, both buyback, dividend, is extraordinary and is in every single document you produce. It seems front and center for you at all times.
My goal is to be a compounder of tangible book value and dividends over time. That's my goal. And there's not many companies that can be compounders, and we are one of them. We're in markets with 1.5 billion people, where we have 173 million customers. LATAM, number one bank with 100 million customers, US. So being a compounder, delivering tangible book value accretion over time in a sustainable way, and the one thing we still don't get is a premium for that. So we are now at the average. I don't like to be average in anything. I think we should deserve a premium because we continue to grow and we can deliver even greater profitability.
I could not agree with you more. You deserve that premium for everything that you've accomplished. I want to thank Ana Botín, who's the executive chair of Banco Santander, and I want to thank all the shareholders who had the faith to be with her because they're none better. The performance states that. Thank you.
So thank you for being an early believer.
It is time to the right with the reference. It's him, Mr. Control, Baba Bites, Super Doodle, Core Stock, Point to myself, Play this out. And then the lightning round is over. Are you ready? Skeet that on the right with the start, Bobby, and you're Bobby.
Hey, Jim. Bobby from Long Island. First time,
good to see you again. All right, okay. What's happening?
Okay, first I want to mention an Eagle from the 1960s, Tom Woodishick.
I love Tom Woodishick. He happened to live about a quarter mile from me, and he lived on Paper Mill Road. I lived on Cheltenham.
Okay.
Cheltenham. Yeah.
He reminds me of Cam Scatterbo. Exactly same kind of runner.
What a buzzkill. How about a stock?
Okay. The stock I want to mention to you is UiPath, symbol PATH.
I'll tell you the truth, buddy. It just had such a big move. I can't recommend it. It just soared. It's not for me. Let's go to Michael in Kentucky, please. Michael.
Mr. Cramer, hi.
Yes.
I'm a long-time listener and first-time caller. And it's
fantastic.
an absolute honor to speak with you, sir. It's an absolute honor.
I'm glad you called.
I'd like to give you an old-fashioned Kentucky booyah.
That is definitely, I can't tell whether that's Lexington or maybe, I don't know where that might be. It might be Louisville. Go ahead. How can I help?
I'd like to just real quick give a shout-out to my loving wife who bought me your brand-new book for my birthday. So shout-out to her. And
on your way.
I just wanted to ask you. I appreciate it. I just wanted to ask you real quick. I see a lot of potential in this. And I was just wondering on your thoughts about maybe starting just a real small position in Archer Aviation.
No, we're going to let that come down. We're in a kind of speculative tsunami right now. I think you'll be able to get that cheaper. Just consider it like a maiden claiming race, okay? And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
Next week, I'm headed out west for my annual pilgrimage to Salesforce's Dreamforce Conference. It's a celebration of all things tech with an emphasis on AI. We're in an odd moment for the software as a service companies right now, companies like Salesforce. These guys have expensive but valuable products that boost productivity, products that some customers are trying to replicate or augment using their own AI so they don't have to pay Salesforce. In other words, the Salesforce model is being challenged. Let's find out what they're doing about it. Of course, I'm not just going out there for tech. For example, we're going to sit down with Brian Niccol, he's the CEO of Starbucks, see how that turnaround is going. I'm on a two-track mission right now, though. First, I'm examining the established profitable companies that are impacted by the rise of the data center. Second, I'm examining those that are in the mix but are not profitable. Why care about the latter cohort? Because you know what? I've started a froth watch with many of these stocks being bid up. GameStop-like by retail, typically using platforms like Robinhood that brought so many newer investors into the market, but not necessarily wiser, just newer. You know, I've been behind NVIDIA the whole way. And I've supported the data center stocks the whole way because of the staggering need for computing power to fuel AI, accelerated computing. But there's another group of red-hot stocks that's antithetical to the very concept I'm investing in. I'm talking about the stocks of super speculative companies that have some contracts and some revenues, but no earnings and none expected anytime soon. Now, many need cash just to sustain their operations. They are often the height of speculation. Now, I'm not against speculation, as you know, from how to make money in any market. I say you can have one spec in a program of 5 stocks, but let's not get out of control. And that's where we are. Going forward, I'm going to start naming the names of these impoverished growth companies, the ones that have been bid up furiously and will likely need to do stock offerings because they're desperate to raise money. That's what happened in the great internet crash of 2000. As the dot-coms took advantage of their sky-high stock prices by issuing new shares, the market was overwhelmed with all the supply. That sudden surge of supply directly led to the crash. Because while individuals moved stocks up then, as they are doing now, those secondary offerings were sized for institutions. When the institutions lost their appetite for this kind of stock, the entire market fell apart as huge amounts of worthless stock wiped out the savings of many individuals, many who never came back again. It also destroyed the performance of many a mutual fund. I think we'll see that pattern play out again with so many of these red-hot speculative names, unless they cool off. Case in point, IonQ, IONQ. That's a huge loss-making quantum computing company with a stock that had bid up aggressively by retail to the point where it rallied 85% for the year as of last night's close. Then this morning, IonQ just offered 2 billion shares. 2 billion shares worth of shares. Well, it's actually more complicated than shares and warrants. It was a complex deal, but it knocked the stock down almost 9% today. I think this offering will be the first of many, and they could weigh on all these stocks. I just hope these deals stay in Sherwood Forest, along with the other Robinhood plays, and don't break out to the rest of the market. In 2000, the losses could not be contained, and they ultimately dragged down almost everything. Sooner or later, though, someone needs to pay the piper here, whether it be nuclear or Bitcoin derivatives or quantum computing or even some of the unprofitable data center adjacencies. I'll be sharing the Sherwood Forest names with the Investing Club in my weekend memo, my think piece. This froth of the forest is in some ways right on time because this is the 3rd anniversary of the bull market, a time of complacency and speculation. So far, you've done fabulous if you speculated in these stocks, but the underlying companies most likely need capital. And after a certain time, it won't be available. Warning, that time is now starting. So please sell some of these specs before the companies and the insiders do the same. At a minimum, please take out your cost basis. I'm sorry I'm going to be harping on this, but I have to. Believe me, I managed money in the year 2000, spent a year shorting these young, profitless dot-coms, all documented in thestreet.com, by the way. We finished up 36% from my hedge fund. If the Red Hots are going into a similar situation, I'm telling you that you need to ring the register. The sooner, the better, even if we came down so much today. We keep hearing there's a ton of froth in this market. That's not true. But there is a Sherwood Forest that's filled with froth. And the Robinhoodies, they won't be able to stop the declines. I like to say, as always, bull market summary. I promise I'll find just for you right here at Mad Money. I'm Jim Cramer. I'll see you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.